Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Hello again. It's Talking Real Money time. I'm Don, along with Tom and you, trying to make your life better by making money easier to deal with and cutting through all the crud out there. I didn't use crap, I used crud. When it comes to investing advice, and oh my gosh, there's just so much bad stuff. It's really hard to keep up with it all. So we kind of cycle through all of the guilty parties, and one of the guiltiest parties in the realm of mass money media are the people who appropriately call themselves the Motley Fool. I mean, really, would you pick that as a name for a serious money-making venture? Yeah, fool. Yeah, I want to be fooled. Fool me. Well, that's kind of what the fool does. People follow them religiously. But what the fool is best at? The fool is best at clickbait. They really are. They have all these stories that they publish that get picked up all over the place with headlines like this one that came out yesterday. 3 Vanguard ETFs, now listen to this carefully, that could help you retire a millionaire. Okay, that pretty much applies to anything.
If you start with multi-millions or what?
Yeah,
start with. Huh.
If you start with $999,000,
these will do the trick.
And then the article is meatless. It is like a vegetarian burger because you get into it in the 3 funds they tell you about.
Yeah.
The S&P 500 Growth Fund. No value whatsoever. The Vanguard Dividend Appreciation ETF,
which is almost the same
actively
stocks.
Managed.
Yeah. Okay. Yep.
And Vanguard Information Technology ETF.
Oh, good Lord.
Those 3. How did they come up with those 3? We have no idea.
They're the first 3 when you go to the Vanguard page, maybe?
That's
a bad joke.
Well, no, here's the thing. What they're doing is they're going, the Vanguard S&P 500 Growth Fund has had annualized returns of greater than 19% since 2010.
Ooh.
Well, why? They don't ask that question. Oh, because growth stocks have in the past decade, done past tense, far better than value stocks over that 10-year time frame, which is basically all they measured. Now, they ignore the fact, Tom, that value stocks over long periods of time have outperformed growth stocks.
And I think that holds true for every 20-year period looking back to somewhere around 1930. You go 20 years, 20 years, 20 years. But there are periods of time when you do not get paid, in industry parlance, the premium for holding those undervalued stocks. Okay, so the Motley Fool, well, you didn't give us the punchline. The punchline is at the end, they say, oh, by the way.
Oh, they always have that. At the very bottom.
Oh, yeah, I love that. At the
very bottom, it says, and we'll show you the 10 best stocks for investors to buy now. The 10 best stocks.
Yeah.
Individual stocks. Now, if you want to learn those 10 best stocks, you have to subscribe to their stock advisor service, which is a stock picking, which we just, in our last episode. I was just going to say,
so if you want to talk about stock picking.
Proved it doesn't work.
No, you need to stick with the same method of delivery. It has not worked, past tense. It has not worked well at all, in fact. Okay, so if we're going to throw people...
Can I let him in on one other little trick here?
Well,
because they claim that the stocks they've picked have done 4 times better than the S&P 500? 4 times? Let me tell you what the trick is here. When they recommend the stock, they track the performance from the moment they recommended the stock in their publication. Now, one, we can't track that, and I Mark Holbert doesn't even track them.
Nope.
So I don't know how they can make this claim. But let's say that the reality is, though, when they recommended that stock, they recommended it to tens of thousands of people simultaneously. So basically, only the first person got that return. Everybody else was paying consistently higher prices as thousands of people go out and try to buy that same stock in the market, eventually diluting the returns down to right about what the market returns.
And by the way, yeah, if you're late to that game, that might be horrible, right? After the stock price has been pushed up. Okay, so
makes me
I am
angry.
for, and as you pointed out, you can't measure their results because it's not public. In other words, there's no place where you can go in and say, well, that sounds
independently verified.
Yeah, thank you.
Like Mark Holbert did.
Or like the Dow Jones S&P indices that we talked about yesterday, where they looked at the actual performance of actively managed mutual funds, and almost 90% of them fail to beat the index. But speaking of the cheesecake, I got to pick on Chuck Jaffe, who normally I
and
like
for those
his
of you
work.
who don't know what he's talking about with cheesecake, that is a euphemism we use for investment, PORN.
Oh, okay. There you go. So because I read his column in the Seattle Times pretty much every Sunday. I think he has a podcast too. We interviewed him once years ago, I think on the old Sound Investing, and I think we might have interviewed him after that. But anyway, so his advice generally is pretty good. We have a little bit of argument with him because I think he does some indexing and some active, and it's like, you're a Republican and a Democrat, but okay, that's his business. But here's where it really upsets me when I read this stuff, because I know it leads you to making bad decisions. In his most recent column, he writes, the Bloomberg 60/40 index, designed to show the results for a classic mix of 60% stocks and 40% bonds, has been getting hammered this year. A 60/40 has been getting hammered this year. So I'm like, whoa, wow, I must have missed something. Yeah, so I decided to look it up.
How did it do?
As of last weekend, a globally diversified stock portfolio with 40% in intermediate term bonds has lost 2.5%. Now, I know both stocks and bonds have gone down, so that's been unusual, but that's not hammered. And I'll give you a couple of examples of what really hammered is, because these are personal examples that I lived through. This is a true story. I played in a state championship game in youth soccer when I was like 14 years old.
Wait a minute. Wait. That was so long ago. Are you sure you can still remember?
I could actually still remember because I played in a fancy stadium.
Dude, that's 50 years ago.
I know. And my friends came to the game and we're watching, but they only lasted a half, because at halftime we were already losing 5-0, and we ended up losing 9-0. Championship game 9-0. That is hammered, okay? We can unequivocally
in soccer that is hammered,
is the equivalent of 70-0 in football, right? Basically. That's a hammering. A 2.5% loss is not hammered. And here's the reason that I really take umbrage with this statement, because I know people read it and they think, oh yeah, I've heard before the 60/40 doesn't work. I got to sell something. I got to do something. If I'm getting hammered, I got to make a move. I think it's poor advice, and it is truly cheesecake. And here's what I think about the rest of that cheesecake. You raise a great point about where it comes from. You should always know the source and the motivation of that source. I think you used the expression clickbait when it came to Motley Fool. Exactly. They're trying to get more of you to say, yeah, these guys have beat this by, what'd you say, 4 times?
4 times the S&P 500.
I got to do that. Yeah, I got to do that. Number 2, I wouldn't read anything about short-term this or short-term that or predictions. Long-term performance, I'm willing to read it. I'll see, what's that talking about? And here's the other number that I think is important. I will put it out there. I would say 99.9% of the advice that you get written, television, radio, podcast, etc., is to be ignored. it is truly cheesecake. Yeah, Larry Swedroe, Paul Merriman, there's voices out there that you should pay attention to that are looking at long-term ways to invest, but most of it, frankly, it's your standard New York style cheesecake, served up cool and should not be swallowed whole.
Well, okay then. Got it. Thank you. Served up cool, but swallowed.
Maybe Cool Whip on it. I don't know.
Okay. I'm going to have to think about that one for a minute.
Swallow, my friend. Swallow.
And speaking, I've made this point for many, many years. In the olden days, back in the old days, it used to be Value Line that claimed that their stock picking beat these huge numbers. And they had this newsletter, and it was a printed newsletter that they sent out for years and years and years, and they claimed that their performance, they were like 3-4 times the indexes, just killing them. So they decided to start their own mutual fund.
That's right.
Using their picks. Their mutual fund underperformed the indexes. Why? Same reason I told you. The market equalizes. If you, Tom, you had a system. You were a brilliant mathematician, which you're not, but we're going to pretend. You're a brilliant mathematician, and you figured out a system like Motley Fool's, where you could make 4 times the market trading stocks, and it always worked. It worked for 20, 30, 40 years. It always works. It always works. Would you sell that to me?
No, I would be in my basement doing it 1 hour a day, and then the rest of the time watching reruns of the El Clasico.
Nobody in their right mind would sell you a system that they themselves could use to make lots of money, because the minute they sell it to you, it dilutes and dilutes and dilutes. And the more of you to whom they sell it, the more dilutive it is. That is why anybody who sells you a get-rich-quick scheme is getting rich via the scheme, the selling you of the scheme, not doing the scheme.
Good way to put it.
All right, here we go. Questions.
Yes.
Questions. They came in like
Enough
mad
cheesecake.
from people all over America.
All right.
Here we go. Don and Tom. Love the way that one starts. I received a huge capital gains lump sum last year of over $50,000 from the Vanguard Target Date 2030.
Oh, you're one of those people. Lovely.
Mm-hmm. One, I've now heard. I now have a huge tax bill of almost $10,000. This was Vanguard messed up here. It's
already a class action lawsuit.
Yeah. Yeah,
of course.
They just messed up. It was really a foolish business decision, in my opinion, on their part. We like Vanguard, but I don't like this decision. She goes on to say, I am freaking out, and I do not blame you. $10,000 is a heck of a lot of money.
Yeah, it is.
I recently heard that if my wages plus capital gains are greater than 132, that I will have to pay back the $7,000 I contributed to my Roth last year.
I don't know the numbers off the top of my head.
Let me find the right number.
I thought it was
I'm pretty sure that's right.
Something.
No, well, she sounds like she may be single.
Yeah, single. I think you're right. I think it starts winding out for couples at like 180 something and goes away completely at like 209.
Hold on, let's find out.
I have a bad feeling that's correct. Yes, so you'll have to go.
I want to check. So this is for 2021.
Correct. Yep.
And for 2021, single filers are at a zero at over 140. Yeah, so at 132, you'd have to take out half.
Scaling down. Yep. Right.
Yeah. At 132, you'd have to take out half.
Which is really unfun because you got to move it back and you're going to have to pay tax on any gain, et cetera. It's not going to be a good day. And I concur. I think that was an outrageously poor decision by Vanguard.
Yeah, they did it. They did it to help out some of their institutional clients, and it ended up hurting a lot of little people,
which they're supposed to be supportive of us little people. If you don't mind.
Me, this is a new world, sir. It really. I'm
not
a
little person anymore. I'm too big now for little person status.
As we said in our video cast last week about the movie Margin Call, it very succinctly states that this business, Wall Street, I don't care what firm it is, generally is not working for the little people. they're working
No,
for the
not,
big people.
not generally.
That's where
They're not working. It's a good question. No, I mean, okay. So you're saying that they don't specifically set out necessarily to do bad, but they would rather
But
they care about the people, the owners, instead
they're
of
going to err
Remember,
toward
but
their
at
big
Vanguard,
clients.
you are the owner.
Yeah, but the bigger clients own a bigger share than you own.
That's a good point. That's a good point. Yeah.
I'm really sorry. That just sucks. It really sucks.
It does.
It sucks.
It was just awful. So yeah,
right,
you pushed yourself out of Roth. Yeah, that's too bad.
Here's another question, and then we're going to wrap up the podcast.
Okay.
All right. Hi. The cash portion of our portfolio is very high right now because of the sale of a family business.
Congratulations.
I'm looking at an ultra short-term bond ETF, VUSB, from Vanguard, versus the floating rate ETF, FFRHX, must be from Fidelity, for the fixed income portion. What is your opinion of floating rate funds ETFs? In this case, the FFRHX looks attractive because the yield is higher, 3.19%,
of course,
versus 1.62, and the variability is lower. Let's see.
The variability is lower on the floating rate? That doesn't seem right.
Probably. Actually, that does actually make... Let me look them up.
Well, okay. But in a general sense, and Don can tell you more why, we're not fans of floating rate securities, generally.
Hold on a minute. I want to look up the number, though. RHX... what? Oh, there it is. Fidelity floating rate high income. The thing I want to look at, and I've never looked at, is the portfolio, because the truth is in the portfolio. If you want to know why the yield is so high,
which is really high. Yeah.
Ready?
20% is crazy.
Ready?
Yes. Yeah.
How much of the portfolio is in investment grade bonds, high quality corporate bonds? Oh, how much is in government first? How much would you guess is in government, Tom?
Oh, let's see. I will say it's high 15% in
go
the
lower. Oh no,
10%,
go as low as you can possibly go.
5%, 3%.
No, as low as you can go.
Oh,
how low can you go?
Zero.
Thank you.
Okay.
And how much is in AA? Zero. AAA, zero. A, zero.
See, this is
triple
why
B,
it's
ready?
gimmicky.
2.
How much?
2.
Yeah.
2% in triple B.
Oh,
everything else is junk.
And this is one of the people get caught up in this trap. I saw that one at 3 and that one's only at 1 something. I'll just take the 3. Yeah, until it has a problem, which
it's companies
today.
That are in trouble.
Yeah, they're paying more, so you'll buy their debt.
That are in trouble. So yes, it's yielding 3.2%. It should be yielding even more than that. But because rates are so low, people are putting their money into junk bonds in an attempt to stretch for yield, and it's so detrimental.
But what's your take overall on floating rate securities?
Well, if you're just looking for income, but the problem is you're not going to get any good quality floating rates. Nobody creates high quality floating rate notes. If they're good quality, wouldn't you rather lock in a rate? Particularly when rates are expected to rise.
Yep.
You only go floating rate because you don't have another choice.
That's because exactly. Those are the companies we're talking about. That's why.
This is crazy. If you're looking for a safe place to keep your money, there is no question that the Vanguard Ultra Short Term ETF, the VUSB, is a much better product. In fact,
what's year to date on the VUSB? Because, as you know, for decades, I've told people to use the Vanguard Short Term Investment Grade Bond Fund, and it is now down almost 4%, I think, year to date. So people
VUSB is only down 1% year to date.
Yeah, so it probably has a shorter,
far less volatile.
Yeah,
the SEC yield is
1%.
1%.
Yeah. The VFSTX, I believe, is still yielding like 1.8, so it's more.
And
you're just taking more risk.
94% of the ultra short-term bond portfolio is investment grade paper with an average duration. Are you ready for this? Duration is less than a year.
Wow. Okay, but since we're on it, what about VFSTX?
No.
What is the average duration there, and what's the quality of that? Because I don't remember last time I looked. It's been a while. I believe it's VFSTX.
It is. You're good. You're good. Okay. You remembered.
I remember that, but I also remember to put people in it, and it is down.
The yield there is 1.59.
Okay, that's come down a little bit. Interesting. Okay.
Yeah, 1.59. And it's quite longer. It's almost 3 years.
Okay. Yeah. You're taking more risk.
The credit quality is almost identical.
Yeah.
Almost
these
identical.
Are good. These are bonds issued by companies that in many cases really don't need to issue the debt, but they do it for reasons of taxation.
Yeah. Yeah. And they do it for reasons of keeping other assets.
Yeah.
That, for example, if a company has a lot of money and it's all tied up in their own stock, well, why would you want to take it out when your stock is doing incredibly well when you can borrow for cash flow needs at 1%?
And my guess, I mean, look at what the bonds are. Look at the companies. I'll bet there's Apple in there. Microsoft from time to time issues this stuff. Like, well, they have the money, but they don't want to spend it.
The top 14 holdings are U.S. Treasuries.
Fairly reliable.
Yeah, followed by Boeing, T-Mobile, Charter, Duke Energy, AT&T,
relatively
AbbVie,
solid
Morgan
companies.
Stanley, Goldman Sachs, Dell. So it's a pretty
I don't see Bear Stearns in there. I don't see Lehman Brothers. You're probably okay.
I don't think you see those anymore anywhere.
You're probably okay. Remember, speak to me as though I was a child or a golden retriever, and everything.
And if you don't know what he's talking about, go watch on YouTube. Go watch okay, here, I'm going to just give you the title.
It's called what did we call that? I named it. Oh, pardon me. I believe that the audio version was quite good. I am listening to that.
Not for you.
There you go. Yeah.
Oh, we're up to 45 views.
Oh, crazy.
Well, I only put it up yesterday.
All right.
That's not terrible.
I'll pop it.
And we have 852 subscribers. Please get us to 1,000. Please.
Just for the sake of dignity, if
just
nothing
because
else.
We want to. Yeah, because we want to be able to say what.
You don't have to watch any. All you have to do is subscribe. You don't have to watch any of them.
No. Go to YouTube and just subscribe to the Talking Real Money channel. You don't have to watch us. I don't blame you for not wanting to watch us. I don't. Please subscribe.
Ridiculous that we have to beg for those while we have almost 3 million audio downloads.
And 852 video
That's
subscribers.
what I'm saying. It's nuts, but okay, whatever.
All right. So, Tom,
apparently the
did
tie
you have some
didn't
questions
work.
You wanted to ask me?
I don't have any questions to ask you today. Where are you going to live in retirement? What are you going to do in retirement?
How do I know where to live in retirement?
How much money are you going to have in retirement?
Can somebody help me figure that out?
Yes, they can. Thank you for asking.
Who can help me figure that out, Tom?
A lot of people. Paul Merriman, you remember him, right? Yeah, sure you do. Herb Weisbaum got a brand new piece about the fact that you're already hacked and what to do next. It's always happy tale. Don McDonald, you've heard of him. Tom Cock, he'll be there. Barbara Devereaux, yeah, you probably may have heard her mentioned from time to time. And Rick Gregrick, Rick's been part of things in the past. All of these people. Kevin Peterson on Medicare.
You forgot.
I'm forgetting
Apollo, water polo boy.
Water polo.
Lupescu.
Apollo Lupescu, of course. All of these people all together, one room, one stage, one production.
10 giant egos on one stage.
We'll see if it all fits. That'll be the fun part. And you can, guess what? You can be part of it. You can be part of it in person, but more likely you're listening to us from a remote location, not in the Seattle area. And so, we're going to do this live on our YouTube channel, and it's going to be cool. That is Saturday, May 14th, Retire Meet 2022. No?
For all 852 subscribers.
No, there's going to be way more than, because we already have 500 people signed up for the virtual session.
Wow.
Anyway, it's crazy. Yeah. So please join us, learn. You'll have fun.
When is it again?
Saturday, May 14th. That's coming up. I mean, we're almost to April here.
14th?
So I think it's May 14th. I think that's right. It's a Saturday. Okay, and it's free for the virtual, but it does cost something.
For some reason, I thought it was the 21st, but
might want to check that. So it's, as I say, free for the virtual. There's a charge for the in-person because there's food. I can't make you. It's like the guy at the soccer game yesterday. I can't make you move. I can't drag you out of the way because you weigh 100 pounds more than me, believe it or not. Right. So anyway, join us. It'll be a good day. We sold out every event.
Everyone's been good.
And it has. Every person who's ever attended really seriously said it's a good event. So there you go. Is that enough? RetireMeet.
That's enough. Let's go.
.com. Okay.
We're
I'm
leaving.
Done. Lunchtime.
All right. We're going to wrap this thing up. I'm Don. That's Tom. Now we're going to go somewhere else and spend some time talking real money.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.